Hi class, today we're going to be looking at chapter 4. We're going to be learning how to do closing entries. You should be able to see problem 4.1b. That's what we'll be working on today. And in chapter 4, we're going to be learning the last steps of the accounting cycle. And in the last steps of the accounting cycle, after you have prepared your adjusted trial balance, you're going to prepare financial statements. So in this problem, they're going to have you doing financial statements. And we're also going to learn how to prepare closing entries that would be made at the end of the accounting period after your financial statements have been prepared. The closing entries will clean up our revenue and our expense accounts as well as our drawing account, so that we can get ready to start a new accounting period in the next accounting period. So always at the end of the accounting period, after you prepared your financial statements, you're going to do some closing entries, which are going to zero out what we call temporary accounts. And temporary accounts are going to be your revenue accounts, your expense accounts, and your drawing accounts. So today's lesson is about reviewing financial statements and how to prepare them, and then how to prepare closing entries. So we've got this company called Last Chance. And what they've shown you in this problem is what we call a worksheet or a spreadsheet. A worksheet or a spreadsheet is something that we can use. It's a tool that we can use to help us to prepare our financial statements. You can prepare a worksheet if you want to at the end of the accounting period after you've completed your adjusting entries. And this is what a spreadsheet or a worksheet would look like. You can see you've got a list of all your accounts. These are the accounts that are in your ledger. All of the accounts that you've used throughout the period would be listed under these account titles, and these are all of your ledger accounts. They have given you the first two columns as being the unadjusted trial balance. You'll remember in chapter 3, or actually it was chapter 2, we learned how to prepare an unadjusted trial balance. The unadjusted trial balance that you prepared in chapter 2 is the same one that is listed here. It's just a list of the ledger accounts and the balances as of the unadjusted trial balance date. You'll remember in chapter 2, we learned how to journalize original entries or your day-to-day entries. And then we learned how to post those to ledger accounts. And then once we got them posted to our ledger accounts, we learned that you would prepare an unadjusted trial balance, which is just a restatement of all your ledger accounts and your ending balances. And then in chapter 3, we learned how to prepare adjusting entries. You'll remember that some of the unadjusted trial balance amounts needed to be fixed or updated, and we did those in the form of adjusting entries. These middle columns for debit and credit represent the adjusting entries that you made. Notice I've got these labeled A, B, C, and D, and these letters are just what we would use to identify our adjusting entries. So you might remember that we had In chapter 3, we learned about deferrals and accruals, deferred expenses, deferred revenue, accrued expenses, and accrued revenue. And we updated our ledger accounts by adjusting those. And that's what these columns are here. Then you'll remember in chapter 3, we journalized our adjusting entries, and then we posted the amounts for those journal entries back to our general ledger. And so the last step that we learned in chapter 3 was that we would need to prepare an adjusted trial balance after we have completed our journal entries. So in chapter 3, we learned how to journalize adjusting entries, post them to the ledger account, and prepare the adjusted trial balance. This is your adjusted trial balance here. And so a worksheet just has information that you've already accumulated previously, and it's just a tool that will help us to prepare our financial statements. So you'll remember one of your first financial statements that you'll have to prepare is the income statement. And on the income statement, we start with a heading. We start with the name of the company, the statement that we're preparing. In this case, we're preparing the income statement, and the time period that we're preparing that financial statement for. In this case, it's for the year ended June 30th, 2019. So we're at the year end and we're preparing our financial statements. Always prepare your income statement first. And on your income statement, you'll remember that we learned in chapter 1 that you will list all your revenue accounts. You will also list all your expense accounts. So in this particular company, we had 2 revenue accounts. And so I listed both revenue accounts. You get these revenue accounts from your ledger. But if you prepared, and you should have, an adjusted trial balance, the amounts will come from the adjusted trial balance that you prepared. So on an income statement, we list all of our revenue. So we'd go through our ledger accounts and we'd pick out our revenue. Our first revenue account that I see is fees earned. You're going to pick up the credit balance that is in the adjusted trial balance. Remember, the adjusted trial balance is prepared after you have updated the accounts through the adjusting entries. So it's very important that you know that you're picking up the adjusted trial balance amounts to prepare your financial statements. So the first revenue account that we're going to look at is our fees earned, and the adjusted trial balance amount is $283,750. So this amount is what I've plugged into my fees earned, showing the revenue account here. That's coming from your adjusted trial balance. Since there were 2 revenue accounts, we had another revenue account that we called rent revenue. Do you see it here? And the rent revenue, the adjusted trial balance amount said that you had $3,000 in rent revenue. So you just copy it in your income statement and put down the amount from your adjusted trial balance. The total of my revenue is added together to find the total amount of revenue for this company at $286,750. The next step in preparing the income statement is to list all of your expenses, and the amounts will come from the adjusted trial balance. So we'll go back and we'll look at our worksheet. We're looking at our adjusted trial balance and our ledger accounts. We want to look for expense accounts. Notice your expense accounts start down here on line 25, which is salary and wages expense, go all the way over to the adjusted trial balance and pick up the amounts for your expense. You would do that for each one of these expenses, and all of these expenses are just recorded in the income statement as a list, and the amounts come from the adjusted trial balance. So once you've got all your expenses written down and recorded, the next step is to total your expenses. When I totaled my expenses, the total of my expenses is $298,775. At the end of the year, once you've added up all your revenues and you've added up all your expenses, you're going to compare your expenses to your revenue. Notice my expenses are larger than my revenue. So in this case, I have a net loss. Net losses will decrease the owner's equity. And this is your first example of a financial statement where you had a net loss. This was a bad year for this company and they have a net loss. Net losses will end up decreasing the owner's worth, the owner's equity. So I want you to realize that the total of your expenses was larger than your revenue, and that's why we have a net loss for this period of time. In review, if our revenue was larger than our expenses, which is not here, but if it was, then there would be a positive net income that would add to your owner's equity. But in this case, we had more expenses than we did revenue, so there was a net loss. Always prepare your income statement first, because your net income or your net loss, as is in this case, is going to be fed into the next financial statement, which is your statement of owner's equity. And so I prepared a statement of owner's equity for you here. And the statement of owner's equity, like the income statement, has a heading on it. It too is going to be prepared for an entire period. So the date lines are very important in preparing your financial statements. This tells you what the statement is prepared for, and this is for a period of time for the year ended June 30th, 2019. The statement of owner's equity is a reflection of what has gone on with the owner's equity account for that period of time. Since this is a business that was in business in a previous period, we need to start the statement of owner's equity with the beginning amount of owner's equity, which we refer to as the beginning capital balance. The name of our owner and the capital account should be shown, and the date, which is the beginning of this year. The end of the year was June 30th, so the beginning of the year had to be July 1st. July 1st of 2018 is the beginning of the year balance for the capital account or the owner. And we get this amount here, this $361,300, from our adjusted trial balance from up above. So all your financial statement amounts come from the adjusted trial balance. This is the capital that we're referring to, and the adjusted trial balance had in it $361,300. So that's your beginning amount of owner's equity that you're starting with. It's your beginning capital balance. Now to this, we would add any additional investments. But for this company, the instructions told us in part 2 that there were no additional investments. So we didn't have any to account for. So what we're going to record next is the net income or the net loss. In this case, we had a net loss of $12,225. The $12,025 net loss is recorded after the beginning owner's equity because there were no additional investments. Technically, there could have been a line in between these two called additional investments, but we didn't have any. So the next step is to report our net income or our net loss. For this year, it was a net loss. So we just write down our net losses. Then we're going to record our withdrawals for the year by the owner. Remember, withdrawals will decrease the owner's equity, so we're lessing out our withdrawals. The withdrawal amount is $20,000, and this $20,000 comes from the adjusted trial balance from up above. Here's your drawing account. This $20,000 adjusted trial balance amount is what we use to prepare the statement of owner's equity withdrawals that would go here. Now, I want you to listen closely to this because we had a net loss, which is negative, and we had withdrawals, which are negative. When we combine the two of these together, the total negative amounts is $32,025. That means that there was a decrease in the owner's equity for this period of time because we did not have a net income. We had net loss, which was a negative, and we are showing that we had some withdrawals that were made by the owner. So the owner's equity total amount decreased by $32,025 in this problem. The decrease in owner's equity would be subtracted from the beginning owner's equity balance, and what you have left is the ending owner's equity for this year. So in this case, we had a decrease in owner's equity. I don't think up until this point you've seen that shown in a financial statement before. But in the real world, we do have net losses that happen, and so there are sometimes decreases in owner's equity. And so it's important that you know that this net loss meant that it puts you further as decreasing the owner's equity. If this had been net income, it would have been combined with the withdrawals. And then if the net income was more than the withdrawals, there would have been an increase in owner's equity, which would have been added back to the beginning owner's equity to get the ending. That did not happen in this case. There was a net loss, which decreased the owner's equity, and the drawing also decreased the owner's equity. It decreased the owner's equity by a total amount of $32,025. You must prepare the statement of owner's equity after the income statement. And you have to prepare the statement of owner's equity before we prepare the balance sheet. The next financial statement we would prepare is the balance sheet. And the balance sheet has a heading on it. Notice the date line of the balance sheet is for 1 day and 1 day only. That's because it's a picture of the company's financial condition as of that 1 day only. Look at your balance sheet. It looks a little different than what we prepared in chapter 1. That's because we have broken our assets down now into 2 categories: current assets and property, plant, and equipment, which we could have called this fixed assets or plant assets as a heading. So our assets are broken down into current assets. The current assets are the assets that we can easily convert to cash or are already converted to cash. So cash is cash, and it's always going to be a current asset, and so it would be listed under current assets on the balance sheet. Accounts receivable is also a current asset. we expect to collect from our customers this amount of the accounts receivable. We will be collecting from our customers within this year, and so that makes it a current asset. Your prepaid accounts are also current assets, and that's because we expect to use up our prepaid accounts within a year. So if we're going to use an asset within a year, or we're going to convert it to cash within a year, it is considered to be a current asset. All of my current asset account balances come from the adjusted trial balance. So my cash was $5,100, my accounts receivable was $26,500, prepaid insurance $2,300, supplies was $525. All of those came from the adjusted trial balance, and were just copied into or underneath the current asset section of the balance sheet. Once you've listed all your current assets, you're going to total them up. So we need to figure out the total of the current assets, and when you combine all these together, that total is $34,425. Then we will list our fixed assets next, which consist of property, plant, and equipment. Our property is our land. Our land account has a balance of $80,000. This too, all of these balances that go on the balance sheet come from the adjusted trial balance. Remember, the adjusted trial balance is the ending balances of our ledger accounts. So our financial statements are prepared with adjusted trial balance amounts. For our land, which is a plant asset, the amount was $80,000. So I'm going to pick up $80,000 and put that down there for land. Notice I've scooted over and made a separate column here for my depreciable assets. I have two assets that are depreciating in this company. One is a building and one is equipment. You're going to start with the building amount, and this cost, this $340,000, comes from the adjusted trial balance for the building. So our building is here. The adjusted trial balance amount of $340,000 is the amount of the cost of that building. Notice we put the cost of the building under the property, plant, and equipment section, or your plant asset section. It goes right here. Now, I want you to look closely at this. Right underneath it is the contra asset account, accumulated depreciation, that goes with the building account. So the accumulated depreciation on the building account is $193,000. I'm getting that from my adjusted trial balance. And the adjusted trial balance accumulated depreciation on the building is $193,000. That's where I'm getting that amount. Notice I put a dividing line here showing that we're going to subtract $193,000 from the cost of the building. What's left over is $147,000 that we refer to as the book value of the building account. So the book value of the building account is the difference between the accumulated depreciation and the cost of the building. So the building cost minus the accumulated depreciation will give you $147,000. That's the book value and must be recorded on your balance sheet. This is the only balance that is not up in your adjusted trial balance. The adjusted trial balance have the accounts, which is buildings, and accumulated depreciations in the adjusted trial balance. But this amount right here, the book value, you have to figure that. And it's figured on the balance sheet, and it's the difference between the accumulated depreciation and the cost of the asset that is depreciating. So the book value is $147,000 that you have to find. The next type of plan asset is equipment. Notice I've got equipment right here at $140,000. $140,000 comes from the adjusted trial balance. So here's my equipment, and here's the cost of my equipment at $140,000. Notice these are not added together to get this. We subtract our accumulated depreciation from our cost, and it gives us the book value, which is placed out to the side out here. This $140,000 is the cost of the equipment. The $140,000 comes from the adjusted trial balance. The accumulated depreciation on the equipment also comes from the adjusted trial balance. So the adjusted trial balance tells us that the accumulated depreciation on the equipment is $59,000. $59,000 is subtracted from $140,000, and that leaves you with the book value of the equipment. The book value of the equipment is $81,000. Once we have written down all of our plan assets, we're going to total our plan assets. And the total of our plan assets is the cost of the land, the book value of the building, and the book value of the equipment combined. So this $308,000 is $80,000 plus $147,000 plus $81,000. My total plan assets are going to be combined with my total current assets to get my total assets. The total assets for this company is $342,425. On the balance sheet, I'm going to list my liabilities. Notice I have a category called current liabilities. These are the liabilities that I can pay off within 1 year. Notice there are no long-term liabilities for this company. They're only current liabilities. And the current liabilities come from the ledger. Accounts payable, salaries and wages payable, unearned rent are all examples of current liabilities. The amounts come from adjusted trial balance. So we go back to our adjusted trial balance. We're going to start with our accounts payable. The $9,750 is the accounts payable. Salaries payable is $1,900. Unearned rent is $1,500. All of these are added together, and they are listed as current liabilities right here. And then we combine the total of our current liabilities to get $13,150. So a combination of accounts payable, salaries payable, and unearned rent is my total current liabilities. These three added together gives you this. Then I'm going to pick up my owner's equity. Always use the ending amount of owner's equity that came from the statement of owner's equity that we prepared earlier. Notice the statement of owner's equities right here. The ending amount, $329,275, goes in the balance sheet right here. This is one that we did not get off the adjusted trial balance, but we did take this from the ending balance in our ledger account, which we haven't finished posting everything to the ledger yet, so it won't exactly equal the adjusted trial balance amount yet, but the ending amount is always brought down from the statement of owner's equity. So all of the account balances go on your financial statements with the exception of capital. Capital came from the statement of owner's equity. So once you have your financial statements prepared, in this chapter, we're going to learn how to prepare closing entries. Closing entries are always prepared at the end of the accounting period after you've prepared your financial statements. The purpose of closing entries are to zero out some of your ledger accounts so that we can start all over again in the next accounting period with a clean slate. Those accounts that you close out are what we call temporary accounts. And temporary accounts are going to be all of your revenue accounts, all of your expense accounts. If you close out all your revenues and your expenses, you're really closing out your income statement. Does that make sense to you? When we close out these accounts, we're forcing the accounts to equal zero. Now, this is the only time in accounting that you are allowed to create some entries. All the other journal entries have to be backed up by source documents, but the closing entries are just cleaning up the accounts and getting them ready for the new accounting period. So to close the accounts, we're going to force them to equal zero. Now, what I did is I chose to put the T accounts for each one of my temporary accounts with the exception of capital. Let me talk to you about capital for just a minute. Capital is not a temporary account. Capital is a permanent account. Temporary accounts are closed out at the end of the period and are going to go away. They're temporary. Their balance is reduced to zero and you get rid of them. But your permanent accounts will stay on your books forever. And capital is a permanent account because it's an owner's equity account. So this is the only T account that I've got represented here that is not going to be closed. Do not close capital. It cannot be closed out. It should always have a remaining balance in it. So the rest of these T accounts that I've got written down here are temporary accounts. They're your revenue accounts, your expense accounts, and your drawing account. All temporary accounts are going to be forced to equal zero. I would start with my revenue accounts or my income statement accounts first. And to close revenue, which has a credit balance from the adjusted trial balance, see, these T accounts represent ledger accounts. You have this amount in there. At the end of the period, after you have finished preparing your financial statements, you're going to want to get rid of this balance. We're going to close it out. And to do that, we simply debit the account for the amount that was credited. This will zero out the account. And this is what we call closing. So I'm going to put here as a note to close it. We debit the account to close it. And right now, if we balance this account, our credit had this and our debit had this. Remember, credits for revenue are adds. Debits to revenue are decreases. So right now we have a zero balance after we prepared the closing entries. So our balance is zero to close out my revenue account. I'm left with a zero balance here. My rent revenue has to be closed out too, so I'm doing the same thing. I'm debiting my rent revenue to close it. And it's going to give it a 0 balance. Once I have posted that to the ledger account. So what I've done is I've debited these revenue accounts to close them. When you debit the revenue accounts, you're putting in the journal first. So this is your formal place to record your closing entries. And these are examples of closing entries. So I'm going to insert a line here. And I'm going to put down here that these are, let me take that back out again. I won't put it there. So bear with me just a second. I'm going to insert a line here, and I'm going to call these closing entries. So you'll know that all of these are closing entries. That we're preparing in the journal. You might remember we labeled adjusting entries in the journal. I'm just labeling these as closing entries so you'll know what we did here. But you close out your revenue accounts. To close them out, we forced this account to 0. So I had to debit my fees earned account. My rent revenue is debited for $3,000. All right, my salary and wages is an expense account. To close it out, I'm going to have to credit it for the amount of the debit. So 147,000 is credited to wages expense. And this is to close it. And then my expense account will have a 0 balance because I've just reduced this out. In other words, expenses have normal debit balances. They increase on the debit side. When I credited it to close it, I have an ending balance that is 0. So after I've closed out my salary and wages expense, it has a 0 balance. My advertising expense, to close it, I would credit it for $86,800. And this is to close it. And once I've closed it, my remaining balance is 0. And this is going to get kind of repetitive, class, because you close out all your expenses in the same way. And because we had so many expenses, it just take a while to do that. So just bear with me. Kind of messy looking. Let me see if I can insert a line there. Yeah, so you can see a little better. I'm doing the same thing on all of my expenses. Zero out all your expense accounts. Insert another line in there too. All right, so kind of keep them separate so you can see a little better. All right, so what I did is I zeroed out all of my expense accounts. And when you zero out your expense accounts, when you close them, you're crediting them. So you see here how I credited $147,000 to my salary expense. To close it, I'm putting that in the credit side. So all of your expense accounts are zeroed out by crediting them. And so all of these expenses become credits here. Now this is a huge journal entry that we're preparing for our closing entries. But what you have to remember, in the first closing journal entry, we close out all of our revenues and our expenses, which is basically our income statement accounts. Now, once you close out your revenues and your expenses, if you look at it, your total debits and credits wouldn't balance in the journal. So you have to have a balancing entry here where we debited our capital for the amount of the net loss. So in other words, when you do closing entries, your income statement is disappearing. It's going away, because next period we want to start from scratch and we want to measure what happens to our revenues and our expenses next period. And so we're zeroing out these accounts to close them out so that we can start all over in the next accounting period. Well, in this case, you see that we had a net loss. And you remember when we said that net losses will decrease our owner's equity. We've said it a couple of times. We said it here in the statement of owner's equity. Well, you've got to show that in your capital account. So this net loss is decreasing the capital account. The capital account had a beginning credit balance of $361,300. This beginning balance is what we had in our ledger account. And then we're going to record a decrease because we had a net loss to our capital account. So in our closing entries, to balance the first closing entry out, we would have to debit Tammy Garrigan Capital for the amount of the net loss. And when you do that, if you combine all your debits and all your credits together, this journal entry should be in balance now. Now, this is what happens if there is a net loss. Let's think about a what if. What if we had a net income? Do you remember that we said net income would add to our capital? So net income would be recorded on the credit side. You would still close out your revenues and your expenses just like you did before, but if this was net income, capital would have been credited for the amount of the net income in that first closing entry. It's important that you recognize the difference between net income and net losses. In this problem, there was a net loss, so we decreased our capital account by debiting it. If there had been net income, we would have credited the capital account. But the revenue and the expense accounts would be closed out just the same. Our second closing entry is to close out the drawing account. The drawing account is the owner's withdrawal. And the drawing account had in it $20,000 from our adjusted trial balance. Our adjusted trial balance had $20,000 in it. So to close this account out, we have to credit it. To get rid of it, we're cleaning it up, we're closing it, so that our drawing account will end up with a zero balance after all of these transactions are posted to the ledger. Remember, these T accounts are just representing the ledger accounts. They're just tools that help us to figure out what to put in our journal. So notice in my journal, I have debited my capital account. And the reason for that is because drawing or withdrawals will decrease the owner's equity account, which is your capital account. To decrease owner's equity, we debit it. So we had to debit the capital account for the drawing amount, and then we have to credit the drawing account to reduce the drawing account to zero. Notice again, I'm going to emphasize again to you, capital is not a temporary account, it's a permanent account. It should have an ending balance when you're through. The temporary account should have zero balances. You see all those zeros up there? So the ending balance for capital, because it's permanent, is this amount. Now I want you to look at this T account here for capital. This beginning balance came from the adjusted trial balance. My net loss was debited in my closing entry. My drawing was debited in my closing entries. And if I take this beginning balance and subtract these two items from it, this will leave me with my ending balance, which has to agree with my statement of owner's equity. So the statement of owner's equity is right here. Do you see this amount is in agreement with the capital amount of the balance here? They have to be in agreement. So there are two closing entries. The first closing entry will close out all your revenue and expense accounts. They close the difference, which is net income or net loss, to capital. That's the first closing entry. The second closing entry is to close the drawing account to capital. Once you have these journalized, the next step is to post them to the ledger. And when you post them to the ledger, the ending balances of these accounts should be what's in your ledger account. The next step, after you've posted to your ledger the closing entries, is to prepare your final trial balance, which is called a post-closing trial balance. After the closing entries have been journalized and posted, you'll prepare a new trial balance. The new trial balance is a list of all your ledger accounts that are left. These ledger accounts that are left are what we call permanent accounts. And permanent accounts are your balance sheet accounts. In other words, they're assets, they're liabilities, they are the capital amount on your balance sheet. Remember, the balance sheet was a restatement of the accounting equation. So we started the problems with the accounting equation and analyzing transactions through accounting equation. We're ending the cycle with the accounting equation again, which is your balance sheet accounts. They are your permanent accounts. So what's left in the ledger is what we call permanent accounts, and they are the accounts that will go on the post-closing trial balance. They are your balance sheet accounts. So the cash account is left in the ledger. We never ever close out cash because we could be out of business. We got to have some cash to operate with. And that balance was $5,100 from the adjusted trial balance. Our accounts receivable is never closed because it's an asset account. $26,500 is what we've got in our accounts receivable. Notice I'm putting these down as debit balances. These are the debit balances in our ledger accounts. If it has a credit balance, it goes in the credit column. So all of these are balance sheet accounts. They're the remaining accounts that are listed in your ledger. That's the post-closing trial balance. So your prepaid insurance had $2,300 in there from your ledger account. There it is. That's also what we reported on the balance sheet. So there's two places you could get that amount from. But basically, this should be from the ledger. Supplies is $525. Supplies is an asset account. $525 is the balance. Land is an asset account. $80,000 would be on the post-closing trial balance. Buildings is an asset account. $340,000 would be on the post-closing trial balance. Accumulated depreciation is a contra asset account. Contra assets are permanent accounts, so its balance is listed on the post-closing trial balance. Right here it is. So you're listing all of the balances that you have left in your ledger that are assets, liabilities, and your capital account. The other accounts were closed out. Equipment was $140,000. Came from here. The accumulated depreciation on the equipment would be listed next at $59,000 as a credit. See how we listed it here? And then our liabilities came in, and all of these are coming from the adjusted trial balance, with the exception of this one, because we had to add in our closing amounts, and it comes from the ledger account right here. And that ledger account balance is $329,275 right there. And then you add up your debit and credit columns, and they must balance. That's your post-closing trial balance. And these are all of the steps of the accounting cycle. So in chapter 4, we do the remaining steps of the accounting cycle, which are to prepare your financial statements, prepare your closing entries and put them in a journal, post your closing entries to the ledger, and prepare a final post-closing trial balance. And we're through with all the steps of the accounting cycle. So in the next chapter, we're not going to add any more steps. These are the basic foundation of accounting. But what we'll be doing in the next chapter is just adding to what you already know, which are these steps. So you have to get the steps of the accounting cycle down. And this chapter is really hammering it in and going to reinforce that to you. So that's all I want to talk to you about today. I'm going to stop sharing this with you, and we'll see you again next time. Bye-bye.